Welcome to Talk Tickers.
Great to be here.
Today, we are shifting gears a little bit. Usually, we're here dissecting earnings calls. We're looking for that slight edge in guidance or trying to figure out if a CEO is sandbagging their revenue projections.
It's the game we play.
It is. We spend, 90% of our time in this industry just obsessing over alpha generation.
Right. It's all about offense, all about growing the pile.
Totally. We're picking the right equities. We're timing the market. We're seeking yield in places other people aren't looking. We are constantly on the offense.
It's the nature of the beast, for sure. But, very few people stop to think about how quickly that pile can just, evaporate if you leave the back door wide open.
And that is the blind spot. That's exactly what we're addressing today. We're looking at the defensive side of the balance sheet.
The not so glamorous side.
Not at all, but maybe the most critical. Because the reality is, it just doesn't matter if you beat the S&P by 500 basis points for 10 years straight. If one specific event,
just
one catastrophic liability event wipes out that entire compounding history in a single afternoon.
And that is not hyperbole. We see it happen. We're talking about nuclear verdicts. We're talking about liability judgments that don't just take your liquid cash.
No.
They attach to your future earnings for decades. They become a partner in your career.
So today we are dissecting umbrella insurance. And before you tune out thinking this is just, insurance 101 for a suburban minivan owner, let me stop you right there.
It's a common misconception.
It is. This is not about basic auto or home policies. We are going to treat this as a financial instrument. Mm-hmm. In the research packet, you actually referred to this as the umbrella arbitrage.
I did, yes.
Now, arbitrage it's a heavy word in our world. It usually implies a risk-free profit from some kind of price inefficiency.
Right.
So calling an insurance policy, which, let's be honest, is typically a sunk cost, and arbitrage seems like a stretch. Mm. How do you justify viewing a liability policy as a financial instrument?
Well, it really comes down to leverage and pricing efficiency. Think about the options market for a second.
Okay.
If you wanted to buy a put option on the S&P 500 to protect, say, a $10 million portfolio against a 50% drawdown, what's that going to cost you?
A fortune, an absolute fortune. Portfolio insurance is never cheap when you actually need it. The implied volatility would make that premium incredibly expensive.
Exactly. But in the liability world, the market is, I believe, fundamentally mispricing the put option on your personal net worth and your future earnings.
Mispricing it how? Cheaper or more expensive?
Way cheaper. You can effectively transfer millions of dollars of tail risk, the risk of being sued into oblivion for catastrophic accident, to a carrier for literally pennies on the dollar.
Okay, let's get into the numbers then. Talk is cheap. What is the actual cost of this put option?
If you look at the pricing dynamics for the first $1 million in coverage, you are typically looking at an annual premium of somewhere between, say, $150 to maybe $300.
Hang on a second. For the cost of maybe 2 nice dinners out, you are securing a $1 million buffer against a lawsuit.
That's correct. And it gets better. The marginal cost actually decreases as you stack more coverage on top.
It gets cheaper per unit.
Yes. Each additional $1 million increment typically costs less than the first one. You're often looking at adding another $1 million in coverage for maybe $75 to $100 a year.
So if I buy a $5 million umbrella, my blended cost per million drops significantly.
Precisely. It's an economy of scale on risk transfer. You are transferring 7 figures of tail risk to an A-rated insurance carrier for 3 figures of premium.
You would never find that in the financial markets.
Never. You'd never find a hedge this cheap relative to the notional value it protects. That's the inefficiency. That is why I call it an arbitrage. It's an inefficiency in how personal catastrophic risk is priced relative to the devastation it prevents.
Okay, I'm listening. But let's clarify the scope here for everyone. We aren't covering the basics of your primary liability.
No.
Your standard auto or your homeowners. We are assuming our listeners have that in place. We are talking about the tranche of capital protection that sits above all that.
Correct. We are talking about the tower, the liability tower.
Let's visualize this for the listener. We often talk about capital stacks in corporate finance, senior debt, junior debt, equity. How should we visualize the liability tower for an individual?
You should think of it exactly like a tower or a building. The foundation, let's call it layer 1, is your primary policy.
My auto insurance, my homeowners.
Exactly. Your homeowners, renters, or your auto insurance. Now, these policies have what we call a limit. Let's say you have a pretty robust auto policy, maybe $500,000 in liability coverage.
Which sounds like a lot of money.
It does sound like a lot of money.
Until you hit a surgeon's Tesla.
Or a bus. Or a multi-car pileup.
Right.
Let's play that exact scenario out. You're distracted for 1 second, you look down at your phone, and you cause a chain reaction on the highway.
It happens every day.
3 cars are totaled, 4 people are in the hospital with serious injuries. The total damages, we're talking medical bills, lost wages, pain and suffering. It all adds up to $1.5 million.
Okay. And I've got my $500,000 auto policy.
Right. So your layer 1 policy pays its limit, that $500,000.
Yeah.
It is now exhausted. It has done its job. It effectively leaves the chat.
The insurance company sends a check for the limit and says, good luck with the rest.
That's pretty much it. So now you're staring at a $1 million bill. And without layer 2, that gap, as you call it, is funded by you.
Personally.
It's funded by your personal equity. That means liquidating brokerage accounts. It means tapping into home equity. And in many jurisdictions, it means garnishing your future wages. This is where decades of wealth creation can be destroyed.
So layer 2 is the umbrella.
Correct. The umbrella sits right on top of those primary policies. It stays dormant. It does absolutely nothing until that underlying limit is exhausted. Once the primary policy hits 0, the umbrella kicks in to cover the gap up to its own limit.
So in our scenario, it pays that extra $1 million.
Exactly. And your personal assets are untouched.
Okay, now here is where I want to push a bit on that alpha concept you brought up. Usually insurance just restores you to where you were, it makes you whole, it doesn't give you an edge.
Sure.
But looking at the source material, it seems like the scope of coverage in a true umbrella policy is actually broader than the primary policy underneath it. Is that accurate?
That is a critical distinction, and it's precisely where the alpha comes in. A standard auto policy covers bodily injury and property damage. A standard homeowner's policy covers, incidents at your house.
Right, a slip and fall.
A tree branch falling on the neighbor's fence. But a true umbrella policy often covers something called personal injury.
Wait, isn't personal injury just a fancy way of saying bodily injury? I mean, if I break my leg, that's a personal injury to me.
In common parlance, yes.
Yeah.
But in the world of insurance contract law, they are totally different concepts. Bodily injury is physical harm, broken bones, blood, things you see. Personal injury, on the other hand, refers to damage to someone's reputation or their rights. We were talking about libel, slander, defamation.
Which is incredibly relevant in the social media era.
It is massive. Let's say you are frustrated with a contractor who did a bad job on your kitchen. You go on Yelp, you go on Nextdoor, maybe Facebook, and you write a scathing review.
People do this all the time.
All the time. And maybe you get a little heated and you accuse them of being a thief or a scam artist. You use some loaded language.
I feel like I see that every single day on Twitter, or X now.
We all do. But if that contractor turns around and sues you for defamation, claiming you damaged his business and cost him hundreds of thousands in lost revenue, your standard homeowner's policy is going to look at that claim and say,
"What? We don't cover that.
We don't cover defamation. That's not an occurrence or an accident at your house." And they will deny the claim.
So suddenly I'm on the hook, not just for a potential judgment, but for the legal defense, which could be massive.
Without an umbrella, yes. But a good umbrella policy one, with what we call broad form coverage, we'll often pick that up. It covers the legal defense costs, which can easily run $50,000, $100,000 just to get the case dismissed, and it covers the settlement or the judgment.
So it's a hedge against your own mouth, or I guess your keyboard.
Essentially, yes.
It too.
And it also covers things you'd never think of, like false arrest, malicious prosecution, invasion of privacy.
And for the landlords listening, and I know we have a lot of real estate investors in our audience, it often covers wrongful eviction or wrongful entry.
That is a huge nuance. That's a real business risk for them.
Yeah.
And another one that jumped out at me from the material is the geographic scope.
Yes, this is another area where the umbrella is broader. Standard U.S. auto policies are generally geographically restricted.
Meaning?
They cover you in the U.S., Canada, maybe a little bit into Mexico if you have a specific endorsement, but they stop at the water's edge. They are not global policies.
So if I'm on vacation in Europe, if you are renting a car in Italy or France and you cause a catastrophic accident, your domestic auto policy from, say, Geico or Progressive is likely useless.
So I'm relying on whatever minimal insurance the rental car company gave me.
Which might be next to nothing. But many umbrella policies, on the other hand, offer worldwide coverage.
So it follows you across the globe. That is a significant value add for anyone who travels frequently.
It is. It's the difference between having a local hedge and a global hedge on your personal liability.
I want to pivot now to the technical mechanics because I think this is where people really get hurt. It's in the fine print.
It's always in the fine print.
You can't just go out and buy an umbrella policy in a vacuum. You have to qualify for it, and there are some very strict covenants involved regarding your underlying policies.
This is the underlying limit requirement, and it is the single most common and most devastating failure point I see.
Yeah.
Because the umbrella carrier is agreeing to take the risk only if you agree to absorb the first tranche of loss through your primary insurance. They are not signing up to be your primary insurer. They are an excess carrier.
So there is a floor. There's a minimum amount of primary coverage you have to maintain for the deal to be valid.
Exactly. There's a floor you have to hit.
I was looking at one of the underwriting sheets you sent over, and I see these three numbers everywhere, 250, 500, 100. It looks like a locker combination. What specifically do those numbers represent in the liability stack?
Those are your split limits, and they are the gatekeepers to getting an umbrella policy. The first number, 250, represents $250,000 of coverage for bodily injury per person. So if one person is hurt, the policy pays up to that amount for them.
Okay. And the 500, what's that?
That is $500,000 for bodily injury per accident. That is the total pot of money available for everyone injured in the crash.
So if you hit a minivan with 4 people in it, that $500,000 has to be split among all 4 of them.
Correct. No one person can get more than 250, and the total for everyone can't exceed 500.
And the last number, the 100.
That's $100,000 for property damage. That pays for the car you hit, or the telephone pole, or the storefront you crash into.
100,000 seems kind of low for property damage these days. You hit a new luxury SUV and you're already halfway there.
You're absolutely right. And honestly, many brokers now recommend bumping that property damage limit up. But strictly for the umbrella to attach, 500 and 500 and 100 is usually the minimum required split limit.
And what if I have a different kind of policy? I've heard of CSL.
CSL, or a combined single limit policy, is simpler. It's just one big pot of money. For that, the umbrella carrier usually requires a flat $500,000 limit.
And this doesn't just apply to my daily driver sedan, right?
Not at all. This applies to every motorized toy you own. ATVs, motorcycles, snowmobiles, motorhomes, they all have to meet these underlying limits.
What about boats?
If you have a jet ski or a boat, the requirement still stands. Though high-performance watercraft, say, something over 350 horsepower, might require even higher underlying limits, like 500,000 straight across the board. The risk is just that much higher.
Okay, here's the trap I really want to highlight for people. This feels like a behavioral economics failure just waiting to happen.
It is.
Let's say I buy the umbrella policy today. I do everything right. I have the right auto limits. But then 2 years later, I'm shopping around for car insurance because my rates went up.
Right. You're looking for a better deal.
Exactly. And I find a carrier that gives me a cheaper rate. But to get that rate, I drop my liability limit down to $100,000. I think to myself, great, I just saved $50 a month. What have I just done?
You have just created a gap, and it is a potentially catastrophic one.
Explain the physics of that gap. What happens in a claim?
Okay, so you have that big $1.5 million accident we talked about. Your primary auto policy pays its new lower limit of $100,000.
Right.
But the umbrella policy was written with a warranty, a legal promise from you, that it doesn't have to kick in until the primary coverage hits $500,000.
Oh, no.
So you now have a $400,000 hole sitting in the middle of your defense tower.
And who pays that $400,000? The umbrella company will just step in.
Absolutely not. You do. You are now self-insuring that gap out of your own pocket.
So I have to burn through $400,000 of my own money before the umbrella will even look at the claim.
That's the best case scenario. In a worst case scenario, depending on the contract language, the umbrella carrier might argue that you violated the warranty of the policy by failing to maintain the required underlying limits, and they could deny coverage entirely.
You're kidding.
I am not. You jeopardized a multi-million-dollar shield to save $20 or $30 a month on car insurance premiums. It happens all the time.
That is the absolute definition of stepping over dollars to pick up dimes. It's a classic portfolio management error. You failed to maintain the hedge.
Precisely. You have to view the entire tower as one single integrated system. You cannot change the foundation without checking the blueprints of the penthouse. They have to match.
That's a great way to put it. Now, I want to get into a bit of nomenclature nuance here. We hear the terms excess liability and umbrella liability used interchangeably on the street.
All the time.
Even brokers sometimes mix them up. But strictly speaking, from a legal and contractual standpoint, they are different instruments, aren't they?
They are structurally different, and that difference really, really matters when you get into the weeds of a complex claim.
So break it down for us. What is excess liability?
Excess liability is strictly what we call follow form. Imagine it as a sheer vertical extension of your primary policy. It does nothing more and nothing less.
That's just more money.
It's just more money. It adheres exactly to the definitions, the exclusions, and the terms of the underlying policy. So if your primary auto policy says, no, we don't cover this, the excess policy automatically says, we don't cover it either. It literally just adds zeros to the limit. It adds height to the tower, but it does not widen the base.
Okay. And an umbrella policy, how is that different?
An umbrella liability policy can be broader. It doesn't just sit on top. It can actually expand outward. It can widen the base.
Meaning it can cover things the primary policy weren't.
Exactly. It may cover risks that the underlying policy explicitly excludes. We mentioned libel and slander earlier. That's a classic example. Your homeowner's policy says no, but the umbrella says yes. Or that accident that happens overseas.
And this leads us to what you called the killer feature, the drop-down provision. I want to circle back to something you mentioned earlier because it sounded like a contradiction. You said this policy sits on top of my auto insurance, but then you said it can cover things my auto insurance refuses to cover. How can it be a top layer if the bottom layer doesn't even exist for that specific claim?
That is the paradox of the drop-down, and it is the single most important feature to look for in a policy. This is what separates a good policy from a great one.
So walk us through the mechanics. How does the tower physically shift in that kind of scenario?
Okay, let's visualize the standard tower again. The foundation is your auto policy. The penthouse is the umbrella. Normally, you burn through the foundation, you use up all the money, and the umbrella catches you before you hit the ground.
You're right. It's the backstop.
That's standard excess coverage. But let's use that gap scenario we talked about with international travel. Let's say you are renting that car in Italy. You decline the rental company's insurance because you think, hey, I have Amex, I have my U.S. auto policy, I'm covered.
A lot of people think that.
A lot of people do. But then you read the fine print of your U.S. auto policy, and it almost certainly says territory. United States, its territories and possessions, Canada and Puerto Rico. Italy's not on that list.
So I crash the Fiat in Rome and I call my U.S. insurer and they say, sorry, we don't know you. You're outside the coverage territory.
Exactly. The foundation of your tower just vanished. You were standing on air. Now, in a standard follow form excess policy, the umbrella looks down, sees no primary insurance paying out, and it says, if they don't pay, I don't pay. I only follow their lead.
And I'm on the hook for everything. The car, the medical bills, everything.
Everything. That is terrifying. I think most people assume umbrella means blanket protection for anything and everything.
And that's the danger of buying a cheap cut rate policy.
It is. But if you bought a true umbrella policy with a drop-down provision, the physics of the claim change completely.
How so?
The umbrella sees that the primary auto policy denied the claim because of the location. But the umbrella then looks at its own rules, and its own rules say, I cover worldwide incidents.
So it has a different set of rules.
A broader set of rules.
Yeah.
So the umbrella literally drops down to the pavement. It drops down and becomes your primary insurer for that claim.
It replaces the missing foundation.
It does. It fills the gap. Now, there is a catch. Of course there's a catch.
I was waiting for that.
Since there is no primary insurance to eat the first chunk of the loss, the umbrella usually demands you pay a self-insured retention, or insure.
Which is just insurance speak for a deductible, right?
Effectively, yes. But it's usually a high one, maybe $500, $1,000, sometimes up to $10,000.
So I pay the first, say, 10 grand of the accident in Rome, and then the umbrella pays the remaining $1 million.
Exactly. And when you compare paying $10,000 to the alternative, paying the full $1 million yourself, you can see why the drop-down provision is the non-negotiable feature.
That makes perfect sense. The SR is the entry fee you pay to get the umbrella to act as your primary coverage when it normally wouldn't.
Correct. That's a great way to think about it.
Okay, I want to shift to underwriting red flags. Because unlike a standard auto policy where they mostly just run your driving record and your credit, umbrella underwriting seems to look at your total lifestyle risk profile.
They do.
I was surprised by some of the things that can make you uninsurable or just really expensive in this market.
They are looking for what the law calls attractive nuisances. That's the legal term of art. They are looking for things on your property that attract people, especially children, and have a high potential to get them hurt.
Give me the top of the list.
Swimming pools are number one, always. Especially if they have a diving board or a slide. Those act as liability multipliers.
What about trampolines?
Trampolines are a close second. Many standard carriers flat out refuse to write an umbrella policy for you if you have a trampoline without a safety net, and some carriers won't write it even with one. The injury statistics are just that bad.
Okay, what about pets? I've heard a lot of mixed things here.
Dogs are a major, major underwriting factor. And it's not just a simple, do you have a dog? Checkbox.
It's the type of dog.
It's what kind of dog. Certain breeds, and this is controversial, but it's purely actuarial. Rottweilers, Pit Bulls, Dobermans, Chow Chows can trigger exclusions or much higher premiums. The data shows the severity of claims associated with bites from those breeds is statistically higher.
And if your dog has a history of biting?
If your dog has any history of bites, you might be completely uninsurable in the standard market. You'd have to go to a specialized high-risk carrier.
And then there's the demographic risk, the human risk factors.
Teenage drivers.
Yeah?
It's a huge one. The statistical probability of an accident for a driver aged 16 to 19 is roughly 3 times higher than for an adult.
3 times.
3 times. If you have a teen driver in the house, your umbrella premium is going to reflect that elevated risk. There's no way around it. It's a massive exposure for the carrier.
What about the real estate side? We mentioned landlords earlier. Is there a limit to how many properties you can have under a personal policy?
There is. Rental properties are a multiplier of exposure. Every unit you own is another family, another set of guests, another Amazon delivery person slipping on an icy step.
So what's the cutoff?
It varies by carrier, but usually, once you get to a certain scale, often around 10 or 12 rental units, most carriers will kick you out of personal lines and force you into commercial lines. They view you as a business enterprise at that point, not just a passive investor with a couple of rentals.
That makes sense. And another one that really surprised me from the underwriting guide, your public profile.
Yes. This is subtle but important. If you are a high visibility individual, maybe you're on the board of a prominent nonprofit or a local politician, or even just very vocal online, you are a target. We call this the deep pockets theory.
So if I'm on the board of a nonprofit and something goes wrong with the organization, they can sue me personally.
They can and they will. The plaintiff's attorney is going to name everyone on the board in the lawsuit, looking for anyone with insurance or assets.
So my volunteering at the local animal shelter could actually expose my entire investment portfolio.
If you sit on the board and you're involved in making decisions, absolutely. Now, the nonprofit should have its own directors and officers insurance or D&O, but your personal umbrella is your critical backstop if their policy isn't enough.
Let's talk about exclusions for a second. What is never covered, no matter what?
Intentional acts. This is a core principle of insurance. If you get into a bar fight and you punch someone, insurance doesn't pay. That's a battery, it's a crime. Insurance covers negligence, accidents. It does not cover malice.
Okay, that's clear. What else?
Business activities are generally excluded from a personal umbrella. This is a big one for the gig economy. If you run a consulting firm out of your home office and a client slips and falls in your house during a meeting, your personal umbrella likely won't cover that.
Because it arose from a business activity.
Correct. You need a commercial general liability policy for that.
And contractual liability. That sounds technical.
It is. It means liability you voluntarily assume via a contract. For instance, if you sign an agreement with a venue for an event and it has a broad indemnity clause making you responsible for everything, your umbrella probably won't cover that. And crucially, it always covers others, not you. It doesn't pay for your own injuries or your own damaged car. It pays for the people you hurt.
I want to pivot now to the investor context because I think this is where it all comes together. A lot of people, especially younger professionals, think, I have a net worth of 0, or maybe it's negative because of my student loans, so I don't have anything to lose. I don't need an umbrella.
That is the net worth fallacy. It is one of the most dangerous and common financial planning mistakes a person can make.
So the calculation isn't just assets minus liabilities.
No, absolutely not. The real calculation for your risk exposure is your total assets plus your future earning potential minus your current liability limits.
Future earning potential, that's the key variable people forget.
It is the biggest asset on the balance sheet for most professionals under 50. It dwarfs everything else.
Let's play this out with a real-world example. I'm a 30-year-old software engineer. I have $50,000 in a 401k, but I make $200,000 a year. I feel judgment-proof because I don't own a home, I don't have a big brokerage account. Why should I care?
You should care because you are actually the ideal target for a plaintiff's attorney.
Yeah.
They don't see your $50,000 in assets. That's peanuts.
What do they see?
They see your $200,000 a year income stream. If I sue you and win a $2 million judgment, I can go to a court and get an order that garnishes your wages. In many states, I can take up to 25% of your disposable income from every single paycheck.
For how long?
Until the $2 million judgment is paid off, plus interest. And the statutory interest on judgments can be as high as 9 or 10% per year.
So I could be paying for 20, 25 years.
You could be paying me for your entire career. I essentially become a silent senior partner in your career. Every time you get a promotion, every time you get a raise, I get a raise too. That is the risk you are hedging. You are not insuring your $50,000 401k. You are ensuring your freedom from a lifetime of indentured servitude to a creditor.
That is a profoundly sobering thought. You are insuring your future self, not just your current bank account.
Precisely. It's a hedge on your human capital.
And the environment for these kinds of lawsuits is getting more and more hostile. We keep seeing this term nuclear verdicts pop up in the industry reports. What is the data telling us there?
The data is alarming. Inflation isn't just for the grocery store or the gas pump. It's hitting jury awards in a big way. We call it social inflation.
Social inflation.
The data shows that jury awards exceeding $10 million, what we define as a nuclear verdict, increased 27% year over year recently.
27%. That's not inflation, that's hyperinflation. But why? What's driving it? Is it just that people are angrier or more litigious?
It's more psychological than that. A big part of it is what we call desensitization. Jurors read the news. They see billion-dollar valuations for tech startups that don't make any money. They see trillion-dollar government spending bills.
So $1 million just doesn't sound like a lot of money anymore.
It doesn't. A $10 million judgment for a horrific car accident doesn't shock the conscience the way it did 20 years ago. The numbers have lost their meaning.
And there's another factor, right? The reptile theory.
Yes, the reptile theory. That sounds like something out of a sci-fi movie, but it's a very real and very effective strategy used by plaintiff attorneys in court.
How does it work?
They don't just argue for compensation for the victim. That's the old way. The new way is to appeal to the reptile brain of the juror, the most primitive part of the brain that cares only about safety and survival.
So they're trying to make the jury feel unsafe.
Exactly. They argue that by punishing the defendant, the person or company, with a massive headline-grabbing verdict, the jury is not just helping the victim, they are protecting their own family, their own community from a future danger. They turn a simple negligence case into a moral crusade to make the community safer. And when juries go on a crusade, the numbers get very big, very fast.
So if I have a standard auto policy with a $500,000 limit and the average liability settlement is now climbing past $2.3 million.
You are mathematically underwater before you even walk into the courtroom. A standard policy is just insufficient in this macro environment. $500,000 was a lot of coverage in 1990. Today, in a multi-car accident with serious injuries and modern medical costs, that limit can be exhausted in the first week of intensive care.
Okay, let's talk structure strategy for the real estate investors in our audience. This is the classic debate we hear all the time. LLC versus umbrella. Do I put the property in an LLC or do I just buy a big umbrella policy? Which is better?
The answer is yes.
Meaning both.
Meaning both. It's the belt and suspenders approach. Sophisticated investors use both because they solve two completely different problems.
Okay, break down the role of the LLC first. What's its job?
The limited liability company is a legal firewall. It's a box. Its purpose is to limit liability to the assets inside the box. So if a tenant sues the LLC that owns the rental property, they theoretically can't touch your personal brokerage account or your primary home. They can only get what's inside the LLC.
But there is a weakness there. We hear this term piercing the corporate veil. How easy is that to actually do?
It's much easier than you think, especially for the do-it-yourself landlord who isn't meticulous with their bookkeeping.
Give me an example of how a landlord messes this up.
Okay, here's the classic Snickers bar scenario. You're at Home Depot buying paint and supplies for the rental property. You're at the checkout and you grab a Snickers bar and a soda for yourself. You swipe the LLC's business debit card for the whole transaction.
And that's it. A $2 candy bar can bring the whole thing down.
It can be the thread that unravels everything. That is called commingling of funds. You used business assets for a personal benefit. A sharp plaintiff's attorney will subpoena your bank records. They'll find that transaction, and they'll stand up in front of a judge and argue that the LLC is a sham, that it's just your personal piggy bank. If the judge agrees, the veil is pierced, the LLC is disregarded, and they come after your personal house.
That is terrifyingly fragile.
It is. The other major weakness of an LLC is that it doesn't pay your legal fees. If the LLC gets sued for a slip and fall, you have to hire a lawyer, and that lawyer wants a $50,000 retainer up front. If the LLC doesn't have 50 grand in cash sitting in its bank account, where does that money come from?
You have to write a check from your personal account to fund the defense.
Exactly. So the firewall is already being breached from the inside. Now compare that to the umbrella policy.
What's its role?
The umbrella is a financial backstop. It's a pot of money. It has a duty to defend you. It pays for the lawyers, which often exceed the settlement itself, and it pays the damages. It doesn't care if you bought a Snickers bar.
And there's a tax note here for landlords too, right?
Yes, this is important. Generally speaking, the portion of the umbrella premium that is allocated to covering the rental activity is a tax-deductible business expense on your Schedule E. So the government is effectively subsidizing a portion of your risk management.
So the recommendation is unequivocally both.
Unquestionably. The LLC isolates the asset, the umbrella ensures the equity and pays for the fight. You want the legal shield and the financial shield.
Okay, let's level up to the commercial focus. We have business owners and executives listening. For them, the stakes get even higher.
They get much higher. If you are a successful business owner, your personal wealth is often very public and tied to your business success. This makes you a target.
The deep pockets theory again.
Exactly. And you need to understand, you need both a personal umbrella and a commercial umbrella. Your personal umbrella explicitly excludes your business liability. There is a firewall between them that you can't cross.
And in the commercial space, the gaps can be even bigger. Let's talk about the exclusion trinity. The data shows that for businesses with revenue over 20 million, there are these huge common gaps in standard umbrella policies.
That's right. Roughly 78% of denied commercial umbrella claims fall into three categories. Number one is professional liability, which is also known as errors and omissions, or E&O.
So that's for people who give advice, consultants, lawyers, architects.
Malpractice. If you give bad advice, and that advice costs the client millions of dollars, a standard commercial umbrella will not cover that. It covers slip and falls, not bad spreadsheets. You need a specific, dedicated E&O policy for that risk.
Okay, what's number two? And I suspect this is the big one today.
It is cyber incidents, data breaches, ransomware attacks. This is the single biggest coverage gap I see in modern business insurance programs.
It's not just included anymore.
Not even close. 10 years ago, maybe you had some token coverage tossed in. Today, it is almost universally and explicitly excluded from standard general liability and umbrella policies.
So if my business gets hacked, my client data is stolen, and then those clients sue me for negligence,
the umbrella carrier will send you a denial letter saying, "Not my problem." The logic from their side is that cyber risk is systemic, it's massive, and it requires its own actuarial tables and underwriting. You need a dedicated cyber liability policy.
And number three in the trinity.
Pollution and environmental liability. If your business operations cause a chemical spill or some kind of contamination, that requires its own specialized coverage.
So the strategy here isn't just buy a bigger umbrella, it's layering.
It is all about layering. You must buy those specialized policies, cyber, E&O, pollution, and place them underneath the umbrella. And this is the critical part. You have to make sure the umbrella is written to specifically sit over those policies. It's not automatic.
You have to schedule them right.
You have to schedule the cyber policy as an underlying layer on the declarations page of the umbrella. If you don't list it, the umbrella won't extend over it, and you've bought nothing.
It's a game of matching the blocks in the tower perfectly. If the blocks don't line up, the entire tower falls down.
Precisely. And for our ultra high net worth listeners, people with 10 million plus in assets capacity becomes an issue too. You might need 25, 50, 100 million in protection. No single carrier might want to take all of that risk.
So you have to syndicate the risk, like a loan.
In a way, yes.
Yeah.
You build a tower of coverage that involves multiple insurance carriers. Carrier A takes the first 5 million of risk. Carrier B takes the next 10 million excess of carrier A. Carrier C takes the top 10 million. It gets very complex, but it's necessary to build those very high limits of protection.
We've covered a ton of ground here. I want to boil this all down to the actionable moment. When one of our listeners is talking to their broker, or maybe they're looking at a policy renewal document, there has to be one question that cuts through all the noise and tells them what they have.
There is the one question.
What is it?
You need to ask your agent this verbatim. Does this policy contain a drop-down provision for claims not covered by the underlying primary insurance? And if it does, what is the self-insured retention in that scenario?
Why is that specific phrasing so important?
Because the answer to that one question tells you everything. It tells you if you are buying a true umbrella policy that broadens your coverage to fill the gaps, like that defamation suit we talked about, or the accident overseas, or if you are merely buying excess liability that just adds zeros to your existing limited policy.
One is a comprehensive shield, the other is just a higher ceiling on the same small room.
That's a perfect analogy. You want the shield.
Powerful distinction. Okay, let's wrap this up with the key takeaways for everyone.
Number one, and this is the most important, check your underlying limits. Your umbrella is completely worthless if your primary auto and home policies don't meet the required liability floor. Usually that's $250,000, $500,000 for auto and $300,000 for home. Do not let that lapse. Don't create a gap.
Okay, number two.
Asset plus income. Do not just insure your current bank balance. Insure against your future earnings potential. Wage garnishment is a 25-year liability. If you're young and a high earner, you are a prime target, regardless of what your current net worth statement says.
And number three?
Macro risk. Settlement inflation is real and it's accelerating. $1 million is not what it used to be. In a world of nuclear verdicts and reptile theory juries, a standard $500,000 limit is a significant vulnerability in your financial plan.
So what's the final thought for our listeners to take with them?
Liquidity is king. We all know that from investing. But protection is the castle wall. Don't let a $300 saving on an annual premium expose a $3 million portfolio to complete ruin. It is, without a doubt, the cheapest money you will ever spend to sleep well at night.
This has been Talk Tickers. Markets close, but risk never sleeps. We'll see you on the next deep dive.
Stay covered out there.